It's the night of February 26, 2022. In Washington, Brussels, London, and Ottawa, finance officials are dialing into an emergency call that, within 72 hours, will hit Moscow's banking system harder than any missile could. 2 days earlier, Russian tanks crossed into Ukraine. Now the United States, the European Union, the United Kingdom, and Canada are about to do something the world has only seen once before. They are about to cut a major economy off from SWIFT. Within days, the ruble will crash to an all-time low against the dollar. Lines will form outside ATMs across Russia as people scramble to pull out cash before their cards stop working. And almost $300 billion of Russia's foreign reserves, 2 decades of careful stockpiling by the Central Bank of Russia, will be frozen overnight, possibly forever. But here's the question almost nobody stops to ask. What actually is SWIFT? It isn't a bank, it doesn't hold money, it doesn't move a single dollar, euro, or ruble. So how does cutting a country off from it cause this much damage, this fast? To answer that, we have to go back to 1973. Before SWIFT existed, banks sent international payment instructions over telex, slow, unreliable, and prone to errors that cost real money. So in 1973, 239 banks across 15 countries came together to build something better, a standardized messaging network headquartered in the quiet Belgian town of La Houppe. They called it the Society for Worldwide Interbank Financial Telecommunication, SWIFT. Today, it connects more than 11,000 financial institutions in over 200 countries, carrying upwards of 40 million messages a day. Every one of those messages is essentially an instruction. Send this amount from this account to that account at that bank. That's it. SWIFT is the address book and the instruction sheet for the global financial system. The actual money still moves through banks. But here's the catch. Without those instructions, banks have no reliable, trusted way to tell each other what to do. A bank cut off from SWIFT is like a company suddenly cut off from email, phone lines, and fax machines all at once, while every client it has is based in a different country. So if SWIFT itself is just a neutral Belgian nonprofit, owned and run by its member banks, how does it become the single most feared weapon in modern finance? The answer comes down to one word: jurisdiction. Because SWIFT is incorporated under Belgian law, it must comply with European Union regulations, whether it wants to or not. And separately, because the vast majority of international transactions, regardless of which currencies they start or end in, are ultimately cleared in US dollars through American correspondent banks, Washington holds a second, even heavier lever over the entire system. Combine those two facts, and you get something extraordinary. The United States and the European Union, acting together, can functionally erase a country from the conversation that the rest of the global economy is having about money. This weapon has been fired before, and the first time it was used, a full decade before Russia, it brought a Middle Eastern's largest economy to its knees without a single airstrike. On March 15, 2012, the European Council quietly adopted a decision that, 2 days later, at exactly 4 p.m. GMT, would disconnect around 30 Iranian banks, including the Central Bank of Iran itself, from SWIFT. At the time, SWIFT's own CEO called it an extraordinary and unprecedented step, one the organization had never been forced to take before. The effect was immediate and brutal. Iran's oil exports, its economic lifeline, collapsed from roughly 2.2 million barrels a day in 2011 to just 700,000 barrels a day by May 2013. That single drop cost Iran somewhere between $4 and $8 billion in lost revenue every single month. Inflation tore through the economy at nearly 45% a year. Unemployment climbed past 20%. Officials in Washington and London later admitted, almost with surprise, that this one financial maneuver had done more damage to Iran's economy than years of conventional sanctions combined. Tehran eventually came back to the negotiating table. In 2016, following the nuclear agreement known as the JCPOA, Iran's banks were quietly reconnected to SWIFT. But that reconnection didn't last. In 2018, when the United States withdrew from that same deal, the switch was flipped again, and Iran's banks went dark a second time. And that's the detail that should stop you in your tracks. This was never a one-time punishment. It was a switch, built once, tested once, and now sitting there, ready to be flipped again on any country at any time Washington and Brussels agree to use it. By February 2022, that switch had only ever been thrown at one country, That was about to change, and the next target wasn't a mid-sized oil exporter. It was the largest country on Earth, a nuclear power, and a permanent member of the UN Security Council. By March 2, 2022, the European Council made it official. 7 Russian banks, VTB, Bank Odkritia, Novikon Bank, Pромsvязьbank, Bank Rossiya, Selfcon and VEB, were given just 10 days to wind down their SWIFT operations. From March 12th onward, they would be completely unable to send or receive a single payment message through the network that connects the world's banks. But notice who wasn't on that list. Sberbank and Gazprombank, 2 of Russia's largest banks, were deliberately left connected. Why? Because Europe still needed to pay Russia for oil and gas, and at the time, roughly 40% of the EU's gas came from Russian pipelines. Even in the middle of an unprecedented financial siege, the dollar and euro system couldn't fully sever ties with Russia, because Europe itself was still plugged into the other end of that pipe. The ruble collapsed within days, and separately, the US, EU, UK, and allies froze close to $300 billion of Russia's roughly $612 billion in foreign reserves. Gold, euros, dollars, pounds, yen, money the Central Bank of Russia had spent years accumulating as a buffer against exactly this kind of shock. Overnight, half of that buffer became useless, frozen, untouchable. Here's the part that should make you sit up. Russia wasn't blindsided. Back in 2014, after the annexation of Crimea triggered the first wave of Western sanctions, Moscow had already started quietly building its own domestic alternative to SWIFT, a system called SPFS. It wasn't ready to replace SWIFT globally in 2022, but it was ready to keep Russia's banks talking to each other and to a handful of friendly countries when the axe finally fell. Russia had seen the weapon coming and started digging an exit tunnel 8 years in advance. But if Russia's response to this weapon was to build an escape route, one country had already shown the world something far stranger 6 years earlier, and it didn't try to escape the system at all. It turned the weapon around and fired it back. Rewind to February 2016. Hackers, later identified by the US Department of Justice as North Korea's Lazarus Group, had spent months inside the network of Bangladesh's central bank. They weren't trying to disconnect from SWIFT, they were trying to use it as a weapon of their own. Using stolen SWIFT credentials, they sent a string of fraudulent payment instructions to the Federal Reserve Bank of New York, attempting to siphon out roughly $1 billion from Bangladesh Bank's account. Most of those orders were caught and canceled, but 5 of them, totaling $101 million, went through. 81 of that landed in accounts at a bank in the Philippines before vanishing into the region's casino networks. For the first time, the world's most trusted financial messaging system had been turned into a getaway vehicle. SWIFT was forced to roll out a mandatory security overhaul, the Customer Security Program, just to make sure it never happened again at that scale. But here's the thing about North Korea. It had already been almost completely cut off from the international banking system since 2013, under UN sanctions designed to choke off funding for its weapons programs. It didn't have a functioning economy to plug into an alternative payment network, so when the traditional banking doors slammed shut, Pyongyang didn't build an SPFS or a CIPS. It went hunting for the one part of the financial world that has no SWIFT, no correspondent banks, no compliance officers, and no way to claw money back once it's gone: cryptocurrency. The numbers are staggering. According to the US Treasury, North Korean state-linked hackers stole more than $3 billion in digital assets over just the last 3 years, funding, by Washington's own assessment, the country's nuclear and missile programs. In one single exploit in 2026, hackers linked to North Korea drained roughly $1.5 billion from a crypto exchange in about 30 minutes. In the traditional banking world, a heist that size would take days to clear, with multiple chances to freeze it. In crypto, once the transaction is signed, it's final, forever. North Korea didn't find a way around the SWIFT weapon. It found a part of the financial world the weapon was never built to reach. So here's where all 3 threads, Iran, Russia, and North Korea, start to converge into something much bigger. Every time this weapon gets used, it sends the same message to every other country watching. This could be you next. And increasingly, the rest of the world is responding by quietly building a parallel financial universe that doesn't run through Washington or Brussels at all. The most advanced of these is China's Cross-Border Interbank Payment System, or CIPS. Launched back in 2015, after Russia's expulsion from SWIFT in 2022, Russia became CIPS's largest user almost overnight. By May 2025, CIPS had grown to over 1,600 participating institutions across more than 180 countries. In 2024 alone, it processed roughly $24.4 trillion worth of transactions, a 43% jump in a single year. And in April 2025, on at least one single day, CIPS briefly processed more total transaction volume than SWIFT itself. Then there's mBridge, a multi-country digital currency platform built by the central banks of China, Hong Kong, Thailand, the UAE, and Saudi Arabia, designed to let countries settle cross-border payments directly in their own currencies, with no dollar and no SWIFT message required at any point. From a tiny $22 million pilot in 2022, mBridge had processed over $55 billion by January 2026, a roughly 2,500-fold increase in under 4 years. The growth was significant enough that the Bank for International Settlements worried that the platform would become a tool for sanctioned countries to bypass the West entirely, stepped back from leading the project altogether. Now, here's the honest caveat, because this is where most videos get it wrong. CIPS still isn't a true SWIFT killer. An estimated 80% of CIPS transactions still rely on the SWIFT messaging network behind the scenes. The dollar still dominates global reserves and trade. None of these systems are ready to fully replace the network built in 1973. But direction matters more than speed. And on December 12, 2025, the European Union made a decision that tells you everything about which direction this is heading. The EU agreed to indefinitely freeze Russia's central bank reserves, removing the temporary renewable nature of the sanction entirely and clearing the path for a $175 billion loan to Ukraine backed by Russia's own frozen money. What started in 2022 as an emergency measure has now become permanent financial policy. And that brings us back to the real question sitting underneath this entire story. SWIFT was never just a messaging system. It was proof of concept for something far more powerful: the ability of a handful of governments to switch a country off of the global economy with a single decision. Every time that switch gets used, it proves how powerful that control really is. But it also hands the next target a blueprint and a reason to build a way around it. So the question isn't really whether the world ends up running on two separate financial systems instead of one. The infrastructure for that is already being laid, transaction by transaction, in Beijing, Moscow, and a growing list of capitals in between. The real question is this: how many more times will the original weapon need to be fired against how many more countries before the alternative it's been quietly building becomes the new default?